If you have a TFSA right now and it's just sitting there like there's money inside your TFSA, but it's basically just chilling in savings mode, well, I need you to stop what you're doing and watch this video, because here's the thing. Most Canadians are unknowingly leaving thousands of dollars on the table every single year, and it's ridiculous. And the worst part is they think they're doing the right thing. So today we're going to talk about the one TFSA mistake I see everywhere, and that is using it like a regular savings account, and why that quiet habit could cost you more than you could ever guess. So let's get into it. All right, before I show you the mistake, before we go deep into this matter, let's just make something clear. Let's just make sure we're on the same page about what a TFSA actually is. Because the name is a little misleading, and honestly, that's quite part of the problem. TFSA stands for tax-free savings account. But here's the thing, the savings account part, that's just the name. It's not really a description of how you're supposed to use the account. So don't think of a TFSA like a regular savings account. It's more of a container, like a very special container that the government has approved. So it is a government approved container where the stuff you put inside, it gets to grow completely tax free. What you put inside that container is entirely up to you. You could put cash in there. You could put investments like stocks, ETFs, mutual funds, GICs, bonds. The government doesn't tax any of the growth inside it, not when it grows, not when you take it out. And that's actually kind of wild when you think about it, because as of 2026, the annual contribution limit to a TFSA is $7,000. And if you've never contributed since you turned 18, your total lifetime limit could be as high as $102,000, which is pretty amazing. You can check your exact room at any time through the CRA My account. I'll drop a link in the description for you guys to use. Here's where most people go wrong, and honestly, it's not really their fault. When you walk into a bank and say, I would like to open a TFSA, they will typically give you a savings account, which is a regular savings account, and just slap the TFSA label on it, right? And technically, it is a TFSA, but functionally, you're earning maybe 1% or 2% interest on your money, and you're walking away thinking you've made a smart financial move. Well, you haven't, and I'm really sorry to tell you. Or at least you haven't made the smartest move. Here's why. Most big Canadian bank savings accounts pay somewhere between 0.5% and maybe 1.5% in interest on a regular basis. Some high interest savings accounts push a little higher and they pay around 2 to 3% interest per year. But that's the ceiling for cash. It doesn't really go significantly higher than that. Now, if you compare that to investing in a simple index fund that tracks the Canadian or the US stock market, historically, the S&P 500 has returned on average around 10% per year on the long run before you account for inflation. So when you adjust for inflation, it probably comes down to around 7% or 8%. The Canadian market on its own has had strong long-term returns too. Now, I know what you're thinking, right? But the market can go down, which is a very, very valid question, a very valid opinion to have. And yes, the market can absolutely go down in the short term, but in the long term, let me show you the math and let me show you how this actually hits home. Let's say you put $10,000 in your TFSA today. So you have scenario A, where you leave it in a savings account, earning 2% interest per year. After 25 years, you would have roughly around $16,400, which isn't bad in itself, right? But compared to scenario B, you put that same $10,000 in an ETF that averaged 7% per year, which is more of a conservative estimate, right? After 25 years, you would have roughly $54,000. See the thing that happened. You had the same money, you had the same TFSA, you had the same 25 years. The difference is what you put inside your TFSA container. Now, remember, because it's a TFSA, all of that $54,000 comes out completely tax-free. Every dollar, you don't get to pay a cent of tax on that growth. And that's like life-changing money, really. That's a down payment on a house. That's a trick that you've been putting off for years. And the heartbreaking part is so many Canadians are like scenario A people, not because they made a bad choice, but because nobody really explained that there was a scenario B. And that's where I come in. And that's where this video comes in. Okay, pause. Just take a minute because I want to make sure that what I'm saying is actually landing. I want to make sure that you're actually grasping what I've been talking about so far. And now, three things, right? There are three things which I'll just do a quick recap on. One, your TFSA is a container, not a product. Two, most banks set it up as a low interest savings account by default. Three, the difference between leaving cash in there versus investing can be thousands of dollars over time if you don't make the right decisions, right? Are you still with me? Right? Good. Now, let's talk about the question of what happens if the market crashes. The reality is markets go up and down. It's a cycle, up, down, it happens. And if you are the type of person who would panic sell the minute your balance drops, right, then investing might not be the best decision for you. If you're always jittery, if you have like rubber hands, investing might not be the right decision. But here's the way to think about it that has really helped me. Risk and time, they work together. They're like best friends. The longer you have your money invested, the more time that money has to recover from any dips. And historically, the market always rebounds from any dips. It might take time, but the market usually rebounds. Now, if you look at people who invested through the 2008 stock market crash, remember 2008? Those who invested through 2020 COVID lockdown market downturn, through every rough patch, if they still had their investment up until now, they've come out significantly ahead. Now, if your TFSA is money you need in the next 12 months, like let's say you're saving for a vacation next summer, or you're saving for a wedding next year, or an emergency fund, do not put your emergency fund in the TFSA, by the way. A savings account or a GIC might honestly be the right call for that portion, and there's literally nothing wrong with it. GIC rates right now are sitting between 2.25% and 3.85% for 1 to 5 year terms. So that's not really a bad option for short-term guaranteed money, right? But if your TFSA is money you don't need in the next 5, 10, or 20 years, then keeping it all in cash is the real risk because inflation is quietly chipping away at that money and reducing its purchasing power every year while your account balance is just barely moving. You don't need to be a stock picking genius. You don't need to understand quarterly earnings or read financial reports every single page. The simplest starting point for most people is a low-cost index ETF. It's the same strategy I use for my portfolio. An ETF is an exchange-traded fund. If you don't know what that means, I just explained it. It's an exchange-traded fund, and it basically bundles hundreds and thousands of companies into one investment that you can buy like a stock. So instead of picking one company and hoping that company does well, you're buying a tiny piece of a whole market, or you're buying a tiny piece of a sector. And in Canada, some of the most popular ETF options are things like XEQT or VEQT or VFV. These are like all-in-one funds that hold a mix of Canadian, US, and international stocks. I'm talking particularly to XEQT and VEQT now. VFV, on the other hand, is the S&P 500 stock market. And those are simple purchases that you can just do repeatedly into your portfolio. I'm not here to tell you exactly what to buy. Everybody's situation is different, right? And you should do your own research or speak to a financial advisor. But what I'm actually telling you is the tool you use inside your TFSA matters a lot. So don't let the default choice that was given to you be the only option you would ever consider. To actually invest in your TFSA, you need a brokerage account, not just a regular bank account. And a lot of people use accounts like Wealthsimple, Questrade, and the brokerage arm of their firm. So if you're trying to set up a Wealthsimple account or a Questrade account, I'll put a referral link in the description, so do where to click on that. Many of these accounts don't charge commission on ETF purchases, which means the barrier to entry is genuinely low for regular people. I know personal finance can feel very overwhelming sometimes because it's a lot of numbers, right? And there's so much noise out there. It's hard to know which is real and which is just garbage information. And it's easy to feel like you need to know everything before you do anything. But for this one is quite simple. Your TFSA is the most powerful wealth building tools the Canadian government has given you. It grows tax-free, it withdraws tax-free, and your contribution room never disappears. It's genuinely an incredible gift, but you only have to use it right. So the next time you check your TFSA balance and it looks like a regular savings account, take a minute and ask yourself this question. Is your money working as hard as it could be? Because if it's not, now you know what to do about it, right? If this video has helped you in any way, I would love for you to subscribe and turn on notifications for new content from me. I post videos every week, and if you have a friend who has been parking their TFSA money into savings for years, do them a huge favor and send them this video. Also tell them to subscribe, and it might be one of the most valuable things you've done for them today. Maybe you've done for them this year. Thank you so much for watching, and I'll see you in the next one.